For many, the American dream starts with a college acceptance letter, a moment filled with potential and excitement. The narrative sold is one of success, framed by the historic gates of universities and the promising careers that supposedly lie beyond graduation. Yet beneath this glossy veneer lurks a grim reality, the crippling burden of student loans. College education in America isn't just a pathway to opportunity, it's often a gateway to financial bondage. As young adults throw their graduation caps into the air, many are not just launching their careers, but also a lifelong struggle with debt. This essay explores the stark contrast between the dream of higher education and the harsh financial realities that follow. This narrative isn't just about numbers and policies, it's about real lives caught in the crossfire of a flawed system. As we peel back the layers of the student loan crisis, we uncover not only the suffocating debt, but also the systemic failures that allow such burdens to persist. Let's dive into the world of U.S. student loans, understanding the scale of the problem, hearing from those affected, and discussing potential solutions. Student loans are often celebrated as a tool for democratizing higher education, making college accessible to a broader segment of society. Indeed, for many students, loans provide the only feasible means to pursue higher education, opening doors that might otherwise remain closed. This access is crucial in a society where higher education often correlates with better career opportunities and increased earnings. However, the accessibility of student loans is a double-edged sword. While they provide necessary funds, they also encourage institutions to increase tuition fees, knowing that students can afford them through borrowing. This has led to a spiral of ever-increasing costs, with the burden of debt expanding accordingly. Today, student loans are not just a facilitator of education, but also a significant barrier to financial freedom for graduates. The allure of these loans is rooted in the American value of self-improvement through education. Yet this ideal is now ensnared in financial mechanisms that benefit educational institutions and lenders at the expense of students. As we continue to promote loans as a path to education, we must also ask, at what cost to our young people? The reality of student loan debt is staggering. As of 2023, the total U.S. student loan debt exceeded $1.7 trillion, averaging about $30,000 per graduating undergraduate. This debt isn't just a number, it's a shackle that limits countless aspects of a graduate's life, from career choices to home ownership, even delaying major life decisions like marriage and children. The consequences of carrying such debt are profound. Graduates often find themselves forced into jobs they might not prefer, simply because they need to make enough to cover their monthly loan payments. This economic pressure can stifle innovation and entrepreneurship, as taking risks becomes untenable under the weight of guaranteed debt. Moreover, the mental and emotional toll of this debt can lead to significant stress and anxiety, impacting overall well-being. For those who struggle to find high-paying jobs, the situation is even more dire. The debt-to-income ratio can become overwhelming, leading some to default on their loans, which further damages their credit score and future financial opportunities. The cycle of debt not only affects the individual but also the broader economy, as discretionary spending is reduced, affecting overall economic growth. Repayment plans for student loans are often touted as flexible and supportive, designed to help graduates manage their debts effectively. However, the reality for many is far from this ideal. Standard repayment plans extending over 10 years can result in prohibitively high monthly payments, especially for those at the start of their careers, typically earning lower wages. Income-driven repayment (IDR) plans are supposed to adjust payments based on income and family size, theoretically making them more manageable. Yet, the process of enrolling and staying in these programs can be complex and confusing. Many borrowers find themselves bounced between different plans or dealing with paperwork snafus that can lead to unexpected payment increases or even disqualification from the program. Moreover, while these plans are intended to provide relief, they often result in a ballooning of the principal debt as interest accumulates, sometimes leading to a situation where borrowers find themselves owing significantly more than they initially borrowed. The psychological impact of watching your debt grow despite making regular payments can be deeply demoralizing, further entrenching the feeling of being trapped in a never-ending cycle of debt. Personal stories: the human cost. Meet Emily, a recent graduate who dreamed of becoming a teacher. She now faces over $50,000 in student loans. Despite her passion for education, the bulk of her modest teacher's salary goes towards loan payments, forcing her to reconsider her career choice. Emily's story is not unique. It's echoed across the US as many young professionals find their passions overshadowed by financial burdens. Then there's Michael, who graduated with a degree in biology. Eager to contribute to environmental conservation, his aspirations are on hold as he juggles multiple part-time jobs to keep up with his loan payments. These stories highlight not just the financial implications of student debt, but also the emotional and professional toll it takes on individuals. The narratives of Emily and Michael represent a fraction of the broader impact on society. When educated individuals are unable to pursue careers in their field of study, the investment in education is not fully realized. The cycle of debt, thus, not only impacts the individual borrower, but also stymies the potential contributions they could make to society. The impact on future generations. The ripple effects of the student loan crisis extend beyond individual borrowers, affecting future generations. As young adults delay major life decisions like purchasing homes or starting families due to their financial constraints, the economic implications are profound. This delay in investment and consumption reduces the economic activities that could stimulate growth, creating a drag on the overall economy. Moreover, the burden of student loans is creating a cautionary tale for future generations. As prospective students witness the struggles of their predecessors, there is a growing hesitance to take on debt, potentially leading to a decrease in college enrollment. This could result in a less educated workforce in the future, ironically undermining the very purpose of student loans. Additionally, the psychological impact on families and communities can be significant. Parents who co-sign loans are sometimes left dealing with the debt if their children struggle to make payments, affecting their retirement plans. The stress and anxiety associated with financial instability are not confined to the borrowers, but are shared by their families and communities, perpetuating a cycle of economic hardship. Private lenders play a significant role in the student loan landscape. Unlike federal loans, which have fixed interest rates and come with certain protections, private loans often carry higher interest rates and offer fewer repayment options. This can lead to a situation where students are saddled with even greater debt burdens, complicating their financial situations further. The aggressive marketing tactics used by some private lenders can also be problematic. They often target uninformed young students who may not fully understand the implications of their debt agreements. This lack of transparency can lead to poor decision-making, trapping students in unfavorable terms that haunt them long after graduation. Moreover, the regulatory environment for private lenders has been criticized for being too lax. Advocates argue that more stringent regulations are needed to protect students from predatory practices and to ensure fair treatment. Without significant changes, private lenders will continue to operate in a manner that prioritizes profit over the financial well-being of students. The role of government in the student loan crisis cannot be understated. Federal policies have both shaped and responded to the growing debt levels. For instance, the availability of federal loans has encouraged more students to attend college, but it has also been linked to the rise in tuition costs. As colleges raise prices, knowing students can borrow more. Efforts to address these issues have been mixed. On one hand, there are beneficial programs like public service loan forgiveness, which aims to forgive student loans for those who work in public service jobs after they make 120 qualifying payments. However, the complexity and strict requirements of such programs have led to a low acceptance rate, with many applicants finding themselves ineligible after years of counting on forgiveness. Moreover, recent debates in Congress highlight the political challenges of reforming student loan policies. While there is broad recognition of the problem, partisan divisions and differing views on the role of government in education finance create a deadlock, preventing significant progress. The need for comprehensive policy reform is clear, but achieving consensus remains a formidable challenge. The need for systemic reform in the student loan system is urgent. Advocates argue for a variety of changes, from reducing the cost of higher education to overhauling repayment options to make them truly manageable. There is also a strong call for increased accountability for institutions of higher learning, ensuring they contribute to, rather than exacerbate, the problem of student debt. Specifically, Ideas like tying federal funding to tuition costs or outcomes could incentivize colleges to keep tuition reasonable and ensure that degrees lead to employable skills. Additionally, enhancing consumer protections for borrowers, particularly those dealing with private lenders, is crucial. These steps could prevent students from falling into the debt trap in the first place. Furthermore, there is a growing movement advocating for the cancellation of student debt as a radical solution to free an entire generation from financial purgatory. While controversial, proponents argue that this could provide immediate economic relief and stimulate economic activity, as freed-up income would likely be redirected towards other sectors of the economy. The harsh truth about U.S. student loans is not just a story of debt and despair, but also a call to action. This crisis demands more than temporary fixes. It requires a systemic overhaul to ensure that higher education serves as a bridge to opportunity, not a plunge into financial ruin. We must redefine the value of education in our society, where knowledge and opportunity are truly accessible without the chains of debilitating debt. As readers, policymakers, educators, and citizens, we are all stakeholders in this narrative. It is our collective responsibility to advocate for change, to support policies that offer true relief, and to demand accountability from educational institutions and lenders. Only through concerted effort and unwavering commitment can we hope to dismantle the debt trap and restore the promise of higher education. Let this be a turning point. Let us all be the architects of a new paradigm for student loans and higher education in America.